What does it mean when a business is self-insured or uses a captive insurance company? In this video, we're breaking down how alternative risk transfer works in the property and casualty insurance world, and why more companies are choosing to take insurance matters into their own hands. Let's start with the basics. In a traditional insurance setup, a business pays premiums to an outside insurance company which takes on the financial risk in exchange for that premium. But some businesses, especially larger or more sophisticated ones, decide to keep that risk in-house. That's where self-insurance and captives come in. Self-insurance is exactly what it sounds like. A company sets aside its own money to pay for expected losses, rather than purchasing coverage from a traditional insurer. This is often done for predictable, lower-severity risks, like workers' compensation or general liability claims, where the business has enough historical data to estimate future losses with reasonable confidence. Captive insurance takes this one step further. A captive is a licensed insurance company owned and controlled by the company or companies it insures. Instead of paying premiums to a third-party insurer, the business creates its own insurer to underwrite and manage its risks. Captives are still regulated and must meet capital requirements, but they allow more control, customization, and potential cost savings over time. So why do companies go this route? There are a few major reasons. First, cost control. If a company has strong safety practices and a favorable loss history, it may be able to insure itself for less than what it would pay in premiums to a commercial carrier. Second, flexibility. Traditional insurance policies often come with limitations, exclusions, and rigid structures. Captives can be tailored to fit the specific risk profile and business model of the owner. Another big reason is market conditions. When the traditional insurance market becomes too expensive or coverage is difficult to obtain, known as a hard market, companies look to captives or self-insurance as an alternative. For example, in recent years, rising costs and reduced availability of coverage in areas like cyber, property catastrophe, and medical stop-loss have pushed more businesses to consider captives. Who typically uses captives or self-insurance? This model is most common among large corporations, public entities, nonprofit organizations, and industry groups. You'll find captives in industries like energy, construction, healthcare, transportation, and higher education, where risks are complex, losses are frequent, or premiums have become unsustainable. There are also group captives and association captives where multiple companies band together to share risk and form a jointly owned insurer. This is often seen in middle-market businesses that may not be large enough to form a single-parent captive on their own. Now let's talk challenges. While captives and self-insurance offer many benefits, they're not for everyone. These models require strong capital reserves, ongoing regulatory compliance, and deep expertise in insurance operations and risk management. If losses are higher than expected or poorly managed, it can have serious financial consequences for the company. There's also the administrative complexity. Setting up a captive requires legal, actuarial, and financial work, plus ongoing governance, claims management, and reporting obligations. It's a long-term commitment, and businesses need to be prepared for that level of investment and oversight. But the opportunities are growing. The captive insurance market has expanded significantly in the past decade, with more domiciles offering favorable regulatory environments and businesses seeking more control over their insurance destiny. Innovative captives are now being used not just for traditional coverages, but for emerging risks like climate-related losses, cyber liability, and supply chain disruptions. In fact, the future of captives may include integration with advanced analytics, AI-powered claims triage, and even alternative risk-sharing models that blend traditional insurance with self-insured layers. As commercial insurance markets continue to fluctuate, more companies, especially those in high-risk or underserved sectors, will explore captives as a way to stabilize costs and gain more control over their risk strategy. So what's the takeaway? Captives and self-insurance represent a powerful alternative to traditional insurance. While they're not a fit for every business, they offer meaningful opportunities for companies looking for greater control, flexibility, and long-term cost savings, especially in today's volatile insurance market. If you're exploring a career in insurance or risk management, understanding how captives work is a great way to stand out. Whether you're underwriting, advising, or managing risks, this area is rich with opportunities for growth. If you found this video helpful, be sure to like, subscribe, and follow InsurKnowledge for more P&C insurance insights, career tips, and industry breakdowns. Thanks for watching.